and hello everyone. Welcome to the presentation. Already know the title, High Frequency Tax Information for Tracking Retail, Challenges and Applications. We're going to start with a brief context for this work. Of course, we were last year in the middle of the COVID-19 crisis, and we saw this increase in the demand for high frequency statistics. From the fact that decision makers faced a gap in their information set, the time between when they had to take measures and the time gap between the time when official statistics were available for them. And of course, this is an old problem. We are being requested for new breakdowns to evaluate the impact of these shocks. From the other side of the equation, we have, from the supply side, we have new data sources available for statisticians. So as an example, we have transactional data from POS and scan data, big data, but also administrative records, such as electronic invoices and receipts. The combination of these two forces creates, of course, challenges for statistical offices, since what we have to do is to exploit these new data sources to meet this new demand. Now, let's review some international experience in the elaboration of high-frequency indicators amid the COVID-19 crisis. I have just 3 examples here. We have lots of examples in the world, but we have here the example of the National Statistics Office of Spain, with their work of measurement of large companies' daily retail trade from administrative records. This is actually a presentation that we're going to see in a couple of minutes. The experience of the Bureau of Economic Analysis in the US and the Statistics Office of Denmark, they have created similar projects with credit and debit card transactions of daily spendings by industry. The situation in Chile is that we have 2 main institutions providing short-term statistics on retail trade. So we have our National Statistics Institute, we're going to call it INE in this presentation. They have a trade activity index called AAC with a specific line for retail. This is real information from business surveys and administrative records. And this is a monthly index with a time of release of 29 days after the reference period. We also have data from the National Trade Chamber of Chile. They have a monthly statistics as well, but also a novel weekly sales thermometer, considering only offline sales. This is nominal data from business surveys and is available weekly. Right, so after that context, let's talk about the methodology for this project. So the goal of this project is to provide with a fast and daily index of retail sales for the Chilean economy that is able to complement the official statistic that is prepared by our INE. So we're not trying to compete in the precision of that indicator or the detail of the indicator, but we're trying to complement with new information, with a new breakdown, a daily breakdown, and also with a fast indicator. We have called this project Daily Retail Sales Index, in Spanish, Índice de Ventas Diarias del Comercio Minorista, and we're going to use the name IBDCM in this presentation. So the data comes from the Chilean Tax Agency, and it consists of daily sales of Chilean firms that have been authorized to emit electronic receipts. These electronic receipts include all the transactions. So we have here online and offline card and cash transactions between businesses and final consumers. So what we have here is the B2C world. And this data is updated at the central bank with a delay, a lag of 5 days from the reference day. And I have to say that we don't have access to the specific transactions yet, specific receipts, but we do have here is the total amount of sales for each company in a given day. So it is a good practice when doing experimental statistics to provide some insights about the sample composition. So we can give a warning about possible biases. we have first selected this sample using the National Accounts Business Register to select the retail trade companies. And very importantly, to ensure stability across time, we have selected the companies that are present in the data set with monthly from the period January 2018 to September 2019. Previous to any of the major shocks that our economy suffered after. And the result is that we have a sample of 2,119 firms, accounting for about 1/4, 25% of total retail sales of our country. Now, if we visualize the composition of this sample and we try to analyze these patterns, we see here in blue bars the distribution by firm size of our sample, and we are comparing here with the reference, being the reference here, the VAT declarations of this same the companies of retail sales. So we see here that our sample is dominated by large size firms, and this is going to have an impact on the weights by the industries that are belonging to the retail sales sector. So what we see here is that department stores and pharmacies are going to have a higher weight because these are mainly concentrated industries where we have large companies dominating. And we also see a difference here in gas stations. We are going to have a higher weight as well, but this is because we are building here a gross sales indicator, and we are comparing here with the weights provided by the National Accounts Department that are mainly based on value added. Now, since we are working with administrative records, we are exposed to challenges related to data quality. The first one being outlier detection. And what we are going to do here in this project is to use the two dimensions that are available in the dataset. So we have the number of transactions and the amount of sales for each firm. So then we're going to apply an algorithm called DB-scan, which is an unsupervised clustering algorithm coming from the machine learning toolbox that was especially designed to identify noise. This algorithm is going to identify dense regions based on the concept of Euclidean distances, of course, and any observation here that is outside the valid clusters will be marked as an outlier. We have an example here for a given company. We have transactions on the y-axis, sales on the x-axis, and we have asked this model to classify the observations between valid and noise clusters, and we see that the results are, we are classifying these 4 points as noise. What is interesting here is that the clusters are going to be re-evaluated each time we get new data. So new valid behaviors of firms can be reconsidered as valid. The second challenge is missing value imputation, and here we're going to consider both true missings and also the previously detected outliers. We are going to try to preserve the unique weekly seasonal pattern that each firm is showing us in this database. So we're going to use here an algorithm called STL decomposition. This is a non-parametric model that comes from the econometrics toolbox, and it uses local regressions to obtain the seasonal trend components, and it operates in the presence of missing values. STL is going to first isolate the seasonal component so that we can interpolate linearly the seasonally adjusted series on the missing days. Then it's just we just have to add back this seasonal component to obtain the final imputation. We have an example here of a company in a given period of time. We have created randomly missing values in these pink regions, and we have asked our model to provide with a prediction on those periods. And we have a comparison here with the true value. We see in this last period of time that that the model was able to reproduce the seasonality and follow the trend of the true data. So now let's see the results of this project, how we see the data here plotted from the first day of January 2019 to the last day of July of this year. We see a pretty noisy data set, time series, of course, but we're going to find some patterns, interesting patterns here. These red arrows are the Christmas campaigns, and we here with golden arrows see cyber events such as Cyber Days and Cyber Mondays. We can visualize how important these events have become in recent years. And low points here of the time series are going to be holidays such as the 1st of January, the 1st of May. We're going to zoom in these two periods that are important for our economy. We see here first October 2018, the social unrest event. We have marked here October 18, which is the beginning of this event. And we see this index declining, especially being affected, especially on these two particular days. This is October 20 and November 12. Those were especially violent, difficult days for our economy, and we see declines of 50 and 40 points, and normalization on the first week of December. Secondly, we have the beginning of the COVID-19 crisis in 2020, in March. We have marked here the declaration of the pandemic, March 11th. And what we see is that the week later, we see an increase of 30 points in this index on average, mainly because of provisioning. And when the lockdown started, we see a decline on average of 25 points. What is also interesting in this data is that we can analyze and visualize the changes in the weekly seasonal pattern of retail sales. We previously, of the COVID-19 crisis, we had a high point on Saturdays. What we see after the lockdowns started is that we had a flat week and a decrease on weekends because of course, the lockdowns. If we take a little perspective on the COVID-19 crisis, we can tell a story with this data. We see the pandemic being declared here, a decrease in the index that took about five months, and then we have marked here 3 policies that were relevant for retail sales. In this case, we have the pension fund withdrawals, first and second and third time this happened. We see the reaction of this index to these policies, of course, mixed with other shocks, such as the end of lockdowns and Christmas events, cyber events, etc. So now the question is, how good is this index trying to approximate the reference index from our INE? We have plotted here the yearly changes and monthly changes. And we see a correlation of 0.99 and 0.98 for both measures. We see a median absolute difference between these two indexes of 2.7 and 2.3, which is quite low. So what we can see here is that our index is able to explain the variance of the reference index, in this case from our INE. Similarly, if we just take the first 2 weeks of this index and we do the same calculations, we still see a strong and high correlation between these two indexes. So we see a correlation of 0.96 and 0.84, and the median absolute difference, of course, is going to go up a little bit. So results of this project have been used already in monetary policy reports at the Central Bank of Chile. We have first plotted here the MPR, the report of September 2020, where this data was used to analyze the impact of pension fund withdrawals by industry in this case. And in this case, from very recently in the report of September 2021, this data was used for supply the short-term dynamics of consumption. This is my last slide. So I have to say that this project is part of the experimental statistics initiative of the Central Bank of Chile. We have other projects that are in progress that are also part of this framework. So we have quarterly business demographics, distribution of household income, consumption and wealth, and regional activity indicators, among others. With regards to this specific project, the ABDCM project, we expect to be publishing this index in the coming months. And of course, we are going to be looking forward for our users' feedback. Thank you. Thank you very much. That was my presentation.